Welcome to Griffonomics.
It is great to be diving into this one.
Yeah, so imagine for a second the United States military decides it needs, a brand new fighter jet.
Right, which we've seen play out plenty of times.
Exactly. Historically, we all know exactly how this goes. The Pentagon drafts a requirement, then massive defense conglomerates spend, 15 years in research and development?
Easily 15 years, sometimes more.
Right, and they overrun the budget by billions of dollars, and eventually, they deliver a highly exquisite aircraft. But it requires a pristine 2-mile-long concrete runway just to take off.
And each jet costs so much that, losing even one in combat is basically a national tragedy.
Exactly. It's unsustainable. But today, we're looking at a defense contractor that is completely upending that entire script.
They really are. It's a total pivot.
We are talking about a company that's building heavily armed, jet-powered tactical drones, and these things can launch directly out of shipping containers, and they cost less than, a used Ferrari.
It really is a profound paradigm shift. I mean, for decades, the defense industrial base has operated on a very predictable, incredibly slow, and highly lucrative cycle.
Oh, massively lucrative. For the legacy guys, at least.
Exactly. But what we are observing with Kratos Defense right now is a company that's deliberately breaking those traditional timelines.
Which is why we're doing this deep dive today.
Right. So, based on the stack of sources we've got, and we went through their latest earnings call transcripts, the 10K, the Q1 2026 10Q, plus several strategic financial reports, we are looking at a business sitting at a very critical production inflection point.
Production inflection, that's the key phrase here.
Yeah. They are aggressively attempting to leap from being, a niche mid-cap component supplier right up to a top-tier prime system integrator.
And the entire mission of this deep dive, for you, the listener, is to figure out if they are actually pulling that off, or if they're just burning through investor cash.
Because that is the massive question hovering over the stock right now.
Right. If you're looking at this company, or just following the defense sector in general, you really want to know, is Kratos successfully building an inimitable competitive moat? Or is this massive expansion just a capital intensity trap that's going to dilute shareholders into oblivion?
It's a fine line between the two, honestly.
It really is. So, to get there, we're going to tear down Kratos' entire business model today.
Start from the ground up.
Yeah. We need to dissect their radical 85% solution philosophy. We'll look at the physical scaling of their hypersonic infrastructure in Indiana.
Which is a massive project on its own.
Oh, totally. And crucially, we need to do some heavy forensic accounting. Right. We're going to uncover the truth behind a massive cash leak on their balance sheet and some very high-profile insider swap sales.
Yeah, the insider selling is definitely spooking some people, so we have to unpack that. But to really understand the numbers, you have to start with the psychology of the company.
Okay, lay it out for us.
Well, you literally can't analyze their capital expenditures without understanding their core corporate philosophy. Management summarizes it like this. Affordability is a technology.
Affordability is a technology. I like that.
Right. And they actively operate on the mantra that better is the enemy of good enough.
Yeah.
Kratos is aiming to deliver an 85% solution right now, today, rather than a 100% perfect solution a decade from now.
Which flies completely in the face of how legacy prime contractors operate. I mean, the traditional primes, they chase the absolute bleeding edge of physics.
Oh, they want perfection.
Exactly. They want perfect stealth, perfect sensor fusion, just the ultimate platform. But as you said, that perfection takes decades.
Yeah, it costs billions.
Yeah. It reminds me of Norman Augustine. He was the former CEO of Lockheed Martin. He famously joked that by the year 2054, the entire defense budget will purchase exactly one aircraft.
I love that quote.
Right, and the Air Force and Navy will have to take turns flying it. It's funny, but it's also kind of true. Kratos is basically the antidote to that mindset.
Augustine's law is exactly the context here. Because the Department of War, the Dow, has finally recognized that the trajectory of these exquisite, hyper-expensive systems is mathematically unsustainable in a near-peer conflict.
Because you just can't build enough of them.
Exactly. The Secretary of War has been pushing this United States Arsenal of Freedom initiative. The realization is that if a conflict breaks out in the Pacific or Eastern Europe, a $100 million exquisite drone can get shot down just as easily by a cheap surface-to-air missile.
Which is a terrifying ROI for the military.
Right. And if you only have 5 of those expensive drones, your capabilities zeroed out instantly the moment they get hit.
So the military doesn't just need advanced tech anymore. They need volume. They need mass.
They need affordable mass. That's the
Okay.
buzzword. They are practically begging for systems that are engineered upfront for low-cost, large-scale production,
Yeah, the hardware needs to be what the military calls a tradable.
which is a term we see all over these earnings calls.
Let's actually define that term for you guys listening, because a tradable gets thrown around a lot. It essentially means the hardware is cheap enough and produced in high enough quantities that losing a significant portion of them in combat is mathematically and economically acceptable to the military.
Right. You don't ever want to lose them, obviously.
Of course not. But, I mean, if you send a swarm of 20 drones into contested airspace and only 15 come back, the mission is still a success, and you haven't ruined the defense budget for the next 5 years.
Exactly. You are essentially buying risk tolerance. And Kratos has positioned itself as the premier low-cost provider of military-grade hardware to fill that specific void.
Okay, but I have to push back on this strategy, though, because, I mean, if your entire corporate identity is based on building cheap, low-cost hardware, how do you protect your profit margin?
That is the logical next question.
Right. Doesn't affordable mass just trigger a race to the bottom? If your main selling point is just that you are the cheapest option, won't another company just source, I don't know, slightly cheaper plastic or outsource labor to undercut you?
You would think so, yeah.
Yeah.
But it's actually the opposite. This is where Kratos' strategy gets highly sophisticated. They haven't just stripped out parts to make things cheap.
Okay, what did they do?
They neutralized their biggest supply chain vulnerabilities by creating what I call a margin moat. And they did it through extreme vertical integration.
Explain how that works mechanically. Like, give me an example.
Let's look at their turbine technology segment. Specifically, let's focus on the Mk1 Firejet.
Okay, the Firejet, that's their highly maneuverable tactical drone platform, right?
Yeah.
Used for adversarial training and stuff.
Exactly, sometimes combat roles too. For years, the original classic Firejet relied on third-party engines. They bought them from a vendor called JetCat. But Kratos management recognized a massive vulnerability there.
Yeah.
If you rely on external suppliers for your core propulsion system, which is the most complex and expensive part of the aircraft, your gross margins are completely at the mercy of that supplier.
Oh, right. Because if JetCat experiences, say, supply chain inflation or a raw material shortage, and they raise their prices by 20%, Kratos has a terrible choice to make.
A completely unwinnable choice.
Yeah. They either eat that 20% cost and destroy their own profit margin, or they pass the cost on to the military, which instantly ruins their entire, we are the affordable option pitch.
Precisely. You lose control of your own pricing power. So, to eliminate that risk, Kratos made a massive, internally funded capital investment. They built the Spartan engine facility up in Michigan.
Oh, wow. So they just brought it all in-house.
They did. And they didn't just build an assembly plant. They funded the deep engineering to develop their own internal engine, the J85.
So they own the IP.
They own the IP, they designed it, they manufacture the components, and they assemble it. And they recently integrated that internally produced J85 engine into the new Mk1 Firejet. And they successfully flight tested it in April 2026.
And the sources highlight a pretty wild statistic here. Because of that Spartan facility, Kratos is now the only company in the world that manufactures both a tactical jet airframe and its engine under the exact same corporate organization.
They own the entire stack. And building a jet turbine is incredibly complex. I mean, you are dealing with advanced metallurgy, extreme thermal tolerances, precision machining for compressor blades.
It's not just stamping out plastic parts.
Not at all.
Yeah.
But by internalizing all of that, they capture the margin that used to go to JetCat. And this internal control is exactly what allows them to price the Mk1 Firejet at a highly disruptive sub-$500,000 price point.
Sub-$500,000 for a jet aircraft.
Yeah.
That is less than the cost of some high-end commercial agricultural equipment.
It's insane. And it creates an impenetrable barrier to entry for the legacy primes. Those traditional defense giants typically charge upwards of $2 million, sometimes closer to $4 million, for attritable platforms with similar fighter-like performance.
So no one can even touch Kratos' $500,000 price point without actively taking a loss.
Exactly. But Kratos can maintain strong profit margins because they don't have to pay a markup on the engine. And management actually noted on the earnings call that they plan to scale the Spartan facility to produce thousands of engines this year.
Thousands.
Thousands. And tens of thousands over the next few years.
Okay, so this creates a really clear causal chain. By mastering this low-cost, vertically integrated mass production on the smaller Firejet, they essentially proved their thesis to the DoD.
They proved they could actually do it.
Yeah, they proved the 85% solution works and that they can deliver it at scale. And securing that institutional trust is what allowed them to scale up to much larger, vastly more complex tactical drones.
Which takes us to the absolute centerpiece of their unmanned systems segment.
The big one, the XQ-58A Valkyrie.
Yes. If you are tracking Kratos' long-term valuation, this is the platform driving the narrative right now.
It's definitely the heavy hitter. I mean, the unmanned systems segment, which they abbreviate as KUS, saw an organic revenue jump of almost 31% in Q1 2026.
Massive growth.
And the earnings transcript explicitly states that this growth was predominantly Valkyrie. They just landed a massive $231.5 million contract with the U.S. Marine Corps for these exact aircraft.
That Marine Corps contract is the defining catalyst for them. The Valkyrie is roughly the size of an F-16, and for a long time it was strictly an experimental platform.
Oh, really?
Yeah. Kratos was spending its own private venture capital, taking on massive corporate risk, just to prove the Valkyrie could function as a collaborative combat aircraft.
A CCA in military jargon.
Exactly, CCA. The idea is that this autonomous drone flies alongside a manned fighter, like an F-35. It acts as a loyal wingman, maybe carrying extra missiles or flying ahead to absorb enemy radar.
Kind of like a robotic shield and weapons bay.
Right. And now, with this $231.5 million award, it is no longer an experiment. It is an official program of record.
But signing a contract is one thing, right? Actually building a fleet of fighter-sized drones is another entirely. What do the actual production numbers look like? How fast are these rolling off the assembly line?
So currently, Kratos is executing a 24-unit production run.
Okay.
But management has set a very explicit public goal for their manufacturing footprint down in Oklahoma. They intend to scale up manufacturing to hit an annual production rate of approximately 40 Valkyries by late 2027 or early 2028.
40 tactical fighter-sized drones a year. That requires some serious logistical wizardry.
It's a huge undertaking.
But while I was reading CEO Eric DeMarco's comments in the earnings call, I noticed a very specific caveat about hitting that 40-unit target. It isn't just about adding more floor space to the factory.
No, it's way more complicated than that.
DeMarco stated that hitting the 40-unit goal depends entirely on the military's order mix, specifically the ratio of conventional takeoff and landing versions, which they call CTOL, versus the rail-launched versions. Why does the launch mechanism dictate the factory's total output?
It really comes down to manufacturing bottlenecks and supply chain complexity. So the conventional takeoff and landing version, the CTOL, requires standard heavy-duty landing gear.
Like wheels and struts.
Exactly. It needs complex hydraulics, heavy reinforced struts, and the internal housing inside the airframe to retract those wheels.
Right.
If the military only orders the CTOL version, Kratos' production capacity tops out at around 30 units a year, because the supply chain for those specific aviation-grade hydraulic and landing components is just highly constrained across the industry.
Oh, I see. The landing gear literally slows down the entire assembly line.
Exactly. But a rail-launched version doesn't need any of that.
Wait, how does it take off without landing gear?
It uses a rocket-assisted takeoff, a RATO booster. It basically launches off a static rail using a rocket motor, flies its mission, and then it recovers using a parachute system. It is mechanically vastly simpler to build.
No hydraulics, no heavy struts.
Right. So if the military orders a blended mix of both CTOL and rail-launched configurations, Kratos can optimize the assembly lines, bypass those hydraulic bottlenecks, and hit that 40-unit maximum.
That makes total sense. And this actually connects to a concept that is absolutely vital for understanding modern military doctrine. It's called Agile Combat Employment, or ACE.
ACE is huge right now.
Yeah. If you read any recent wargaming scenarios regarding a near-peer adversary, the consensus is clear. The very first things that are going to get blown up in the opening hours of a conflict are those pristine, 2-mile-long concrete runways.
They are massive static targets.
Exactly. If you're relying on Kadena Air Base in Japan to launch your fighters and it gets cratered by ballistic missiles, your Air Force is grounded.
Which means traditional runways are now viewed as massive liabilities by the DoD.
Precisely. You cannot rely on having a traditional airbase. And this is why the rail-launched configuration of the Valkyrie is so critical. If a drone is rail-launched, you don't need a runway.
You don't need much of anything, really.
Right. You can deploy it from a shipping container or the back of a flatbed truck or even just a small dirt clearing on a remote island or a highway.
Yeah.
So the mix of these configurations isn't just, a manufacturing quirk for Kratos. It is the literal foundation of how the Marines and the Air Force plan to fight a distributed war.
The rail launch capability provides the exact distributed lethality that the Arsenal of Freedom doctrine demands. But bringing this back to the financials for a second.
Let's do it.
Preparing a supply chain to suddenly churn out 40 tactical fighter jets a year in varying configurations requires a staggering amount of upfront capital. You can't just snap your fingers and bend metal for free.
Which perfectly explains why, when you look at their balance sheet, there is a gaping hole.
A massive one.
This was the part of the sources that made me do a double take. We need to do some forensic accounting here for the listener. Let's look at the cash leak.
The Q1 financial forensics are definitely where the story gets incredibly complex. And it's where a lot of retail investors get confused, frankly.
Right, because on the surface, everything looks like a rocket ship. Kratos is reporting record top-line numbers. They have a $2.01 billion backlog. Their revenue growth is up 22.6% year over year.
All great numbers.
But then you look at their operating cash flow, and it was negative $27.4 million for the quarter.
And if you look at free cash flow, which includes their capital expenditures, the money they spend on physical equipment and facilities, it was a net use of $43.1 million.
Okay, I have to stop right there. Because if revenue is surging by 22% and you have a $2 billion backlog, how are you bleeding $43 million in a single quarter?
It looks really bad on paper.
It does. I dug into the cash flow statement, and I saw a massive $28.7 million increase in unbilled receivables, a $14.7 million spike in inventory, and another $26.5 million spike in prepaid expenses.
Yep.
So my question is, if the business is booming, where is all the cash going? Are they just incredibly inefficient at collecting money from the government?
No, it's not inefficiency at all. What you are looking at is the brutal costs of the pre-building strategy.
Pre-building, okay.
This negative cash flow is a highly calculated, intentional drain on their working capital. Kratos is actively choosing not to wait around for the Department of Defense to finalize the paperwork, route it through congressional appropriations, and cut a check before they start manufacturing.
Wait, really?
Yeah. They are taking their own cash and using it to secure long-laid raw materials like specialized aluminum and composites, and physically building Valkyrie drones before receiving formal, signed contract awards.
Hold on. You're telling me they are taking shareholder cash and building multi-million-dollar tactical fighter drones purely on spec?
Essentially, yes.
What if the DoD changes its mind? What if a new administration comes in and slashes the budget? That sounds like a massive gamble.
It is a risk, for sure. But it is a highly mitigated risk. The sources specifically detail that they are heavily investing in the Valkyrie second production Lot 12 build. They explicitly earmarked $25 to $27 million in CapEx for 2026, just for that specific lot.
Okay.
And until the Marine Corps or the Air Force formally executes the purchase order for that exact configuration, those fully built drones just sit on Kratos' balance sheet, classified as company-owned capital assets.
Okay, so it's like a real estate developer doing speculative house flipping.
That's a great way to think about it.
Right. They are using their own cash to completely build the entire neighborhood, pave the streets, put in the plumbing and the landscaping, all before a single buyer has signed a mortgage.
It's exactly like that, but let's add the DoD element to it. It's like building that neighborhood knowing that the local zoning laws and the city council have already publicly stated they desperately need exactly 40 houses built in that specific zip code.
And they already have the budget approved to buy them.
Right. The reason Kratos takes this risk is speed. Remember their core philosophy: better is the enemy of good enough. The DoD wants affordable mass, and they want it right now.
Not in 5 years.
Exactly. If Kratos waits for the formal contract to simply start buying raw aluminum, the supply chain delays mean it takes 2 years to deliver the drone. But if they pre-build, the very moment the Marine Corps signs the paper, Kratos can roll a finished, combat-ready drone right out of the hangar.
And we actually see proof of this working in the 10Q. During this same quarter where they burned massive cash, they actually recorded a distinct $4.2 million cash inflow, specifically from the sale of these company-owned Valkyries to the government.
Yes, they prove the demand is real.
But the math still feels precarious. I mean, if they're burning through $43 million in a quarter to pre-build inventory and expand factories, how are they surviving? How do you fund a $43 million quarterly burn without going bankrupt?
They survive. because they proactively built a massive equity buffer to absorb that exact burn rate.
Ah.
In February 2026, Kratos went to the public markets and executed a colossal $1.35 billion equity raise. They issued 16.4 million shares at $84 apiece.
1.35 billion. That is an astonishing amount of cash to raise in one fell swoop for a company of their size.
It completely transformed their balance sheet. Because of that February raise, combined with an earlier raise in 2025, Kratos paid off every single one of their term loans.
Wow.
They currently hold absolutely zero long-term debt, and as of the end of Q1 2026, they're sitting on a bulletproof cash pile of $1.46 billion.
Zero debt and almost $1.5 billion in the bank.
It's a fortress.
Okay, let's explore the strategic extrapolation of this because the financial reports touch on it. Obviously, having no debt is great for any business. But for a defense contractor specifically bidding on military programs, why does having zero debt matter so much? Is it just a strategic weapon, or is it just good accounting?
Oh, it's absolutely a strategic weapon. Because of how the Department of Defense vets its partners. When the government is awarding massive multi-year programs of record, we're talking franchise-defining contracts that dictate national security agencies like the Defense Contract Management Agency perform intense financial health audits.
Okay.
They cannot and will not give a critical weapons program to a company that might go bankrupt halfway through development, or a company that is so burdened by debt interest payments that they are forced to cut corners on engineering just to make their monthly bond payments.
So having a pristine balance sheet isn't just a nice to have, it's a structural requirement to sit at the big kids table.
It is the ultimate signal of institutional credibility. It proves to the Pentagon that Kratos is a stable, long-term partner, fully capable of funding its own capital expenditures. Kratos can look the Space Force or the Marine Corps in the eye and say, we don't need you to front us the development money. We don't need you to build our factory. We have $1.4 billion in the bank.
We will build the factory, we will build the drones, you just buy the finished product when it's ready.
Precisely.
Which seamlessly transitions us to the next massive evolution of the company. Because that fortress balance sheet didn't just allow them to pre-build tactical drones, it gave them the financial armor to bid on and actually win massive prime contractor roles.
This is a huge shift.
Yeah, we are looking at a fundamental shift in Kratos' corporate DNA, moving away from just bending metal into software and system integration.
This is the strategic inflection point. This is where Kratos evolves from a Tier 2 part supplier into a true top-level system integrator.
The clearest example in our sources is the Space Systems Command contract. Kratos was recently awarded a massive $446.8 million program called Resilient Missile Warning and Tracking the MWT program.
Yes. Specifically, they won the Ground Management and Integration, or GMI, agreement for that program.
But here's the detail that blew my mind when I was reading the contract breakdown. Kratos is the prime contractor on this. They are the lead system integrator, and they are directing a team of subcontractors that includes Northrop Grumman.
It's kind of hard to believe, right?
You really have to pause on that. Kratos was bossing around Northrop Grumman. Northrop is a nearly $80 billion aerospace titan. How does a mid-cap drone and hardware company end up giving orders to a legacy giant in space systems?
It represents a profound role reversal in the defense industry. Historically, Kratos was the nimble, reliable subcontractor. A giant like Northrop or Lockheed would win the multi-billion-dollar prime contract from the Space Force, and they would sub out, the tricky microwave electronics or a specific telemetry antenna to Kratos.
Right, so Kratos got a slice of the pie, but Northrop owned the relationship with the government?
Exactly. But with the GMI award, Kratos owns the relationship.
What capability did Kratos possess that Northrop didn't? Why did the Space Force choose them to lead?
It all comes down to the software architecture. To manage the new constellations of medium Earth orbit, or MEO satellites, the Space Force realized they needed a globally distributed ground architecture. They needed to unify legacy ground assets with next-generation satellite assets into a single, scalable, global network.
Okay.
And Kratos had spent years developing the exact proprietary technology required to do that, a platform called OpenSpace.
OpenSpace. This term is plastered all over the earnings call. CEO Eric DeMarco refers to it as a crown jewel of the company, and he even compared its significance to Anduril's Lattice software.
Which is high praise in the defense tech world.
Very high praise. Let's really break down the mechanics of this, because software-defined ground system sounds like corporate buzzword bingo. How does OpenSpace actually work?
Well, To understand why OpenSpace is revolutionary, you really have to understand the legacy technology it's replacing. Historically, satellite ground stations were entirely hardware-defined. You built a massive physical parabolic dish antenna on the ground. You mechanically tuned that dish to receive one specific radio frequency from one specific satellite.
Okay, very manual.
Super manual.
Okay.
And then you ran physical copper cables from that dish into a physical server rack that was hardwired with equipment dedicated solely to decoding that single satellite signal.
So if the military launched a new satellite with a different frequency, or if an existing satellite moved its orbit, what happened?
You had a massive problem. You literally had to send technicians out to physically swap out hardware, install new modems, and recable the server racks. It was incredibly rigid, incredibly slow, and very expensive to maintain.
So it's like having a physical landline phone wired directly to one specific house in another city. If you want to call a different house, you have to lay a brand new copper wire.
That is the perfect analogy. And OpenSpace changes that entirely by virtualizing the process. It acts like giving the military a smartphone.
Oh, nice.
OpenSpace takes the raw analog radio frequency signals hitting the antenna and immediately digitizes them into data packets right there at the edge. It then processes all that data securely in a distributed cloud environment.
So instead of dedicated hardware modems, it's just software applications running on standard cloud servers.
Exactly. It allows the military to dynamically manage a multi-orbit constellation of satellites built by entirely different manufacturers simply by opening a software application and clicking a button.
Wow.
They can reconfigure a ground station in milliseconds instead of months. Kratos, integrating this OpenSpace architecture into the DoD's Fortige platform, proved they had the engineering depth to handle a prime mission system, which is why they are leading Northrop Grumman.
And from an investment perspective, this software pivot is the holy grail. The financial reports explicitly note this is a deliberate move toward high-margin recurring software revenue.
Oh, absolutely. Software margins are beautiful.
Right. They aren't just selling a piece of hardware once and walking away. They are running the network, licensing the software, and collecting recurring revenue. And this software directly interfaces with their Space Domain Awareness Network, right?
Yes, the SDA network. This is another massive under-the-radar asset. Kratos actually owns and operates a global proprietary network of over 140 RF sensors.
Their own physical sensor.
Their own sensors. These sensors track over 500 operational satellites in the GEO belt, the geosynchronous orbit, where the most critical communications and spy satellites reside. And they recently expanded this physical sensor network into India, increasing their global coverage by roughly 30%.
So they are vacuuming up all this raw radio frequency data from space, tracking who is moving what satellite, feeding that raw data into their OpenSpace software to make sense of it, and then selling that processed intelligence back to the government and commercial operators.
Yep. It's incredibly sticky, high-margin data business.
It is the ultimate high-margin counterweight to the capital-intensive business of bending metal for drones. But speaking of bending metal, we can't just focus on space.
No, we have to look groundside too.
Because while software is the high-margin brain of Kratos' future, we also need to talk about the kinetic muscle. While they are winning space software contracts, they are simultaneously undergoing a massive physical scaling phase back down in the atmosphere, specifically in Indiana.
Yeah, the Indiana facility is wild.
We are shifting gears to the Hypersonics division here. If you want to talk about physical scaling, this is arguably the most aggressive growth area for the entire company right now.
Let's zoom in on Crane, Indiana. The defense and rocket support segment of Kratos reported a 45.8% organic growth rate in Q1.
That is explosive growth for industrial hardware.
Very explosive.
It is, and it's driven heavily by a major infrastructure initiative that Kratos internally calls Project Helios. They secured a $68.3 million contract to build a state-of-the-art mid-tier arc jet and coupled fiber laser facility.
Okay, I have to stop you.
Because this facility is specifically designed for evaluating hypersonic materials, right?
Yes.
Let's unpack the physics of this for a second, because arc jet and coupled fiber laser sounds like science fiction. Why do you need this to test hypersonics? Why can't you just, put a hypersonic missile in a normal wind tunnel to see if it works?
Because a normal wind tunnel can't simulate the extreme thermal dynamics of Mach 5.
Mach 5 is what, 5 times the speed of sound?
Exactly. When a hypersonic glide vehicle is maneuvering through the atmosphere at Mach 5, the friction between the air and the vehicle's surface is so intense that it literally rips the electrons off the air molecules. It creates a sheath of superheated plasma around the vehicle.
Wow.
The temperatures are high enough to melt standard aviation metals instantly.
So an arc jet is essentially a plasma generator.
Exactly. An arc jet uses massive amounts of electrical current to superheat gas into plasma, and then it blasts that plasma at a piece of test material, like a new carbon composite, to see if it can survive the thermal shock of hypersonic reentry.
And what about the lasers?
The coupled fiber lasers are used to simultaneously hit the material with concentrated heat. This simulates directed energy weapons or extreme, localized thermal spikes.
And Kratos is building this capability on a massive 500-acre facility in Indiana, which also serves as their fabrication hub for the Zeus solid rocket motors and the Erinyes hypersonic flight vehicles.
Yes, they've recently had highly successful flight tests of both the Zeus motors and the Erinyes testbed. And that physical success led directly to the largest single contract in Kratos' entire corporate history.
Which one is that?
A $1.45 billion MSEHTB 2.0 contract. This program is designed to provide the DoD with an affordable, high-cadence hypersonic flight test bed over the next 5 years.
I'm going to interrupt and play the skeptic again here.
Go for it.
Because building a tactical drone is one thing. Building hypersonics is an entirely different level of complexity. It requires incredibly advanced energetics, volatile chemicals, highly precise manufacturing, and massive safety protocols. Can a company of Kratos' size actually scale this up alone to meet a $1.45 billion demand signal without stumbling?
That is a very valid skepticism. And the reality is no, they can't scale it alone. And they aren't trying to.
Okay.
This is where their strategic joint venture comes into play. Kratos partnered with Rafael, which is the massive Israeli defense technology company. They created a 50-50 joint venture called Prometheus Energetics, which is based right there on the Indiana campus.
Oh, so it's a marriage of capabilities. Rafael brings decades of deep, specialized technical expertise in energetics and propulsion. And Kratos brings the U.S. manufacturing footprint, the security clearances, and the established DoD relationships.
Precisely. Because energetics, which are the actual chemical propellants used in these solid rocket motors, is a massive bottleneck in the U.S. defense supply chain right now.
I've read about that. We are severely lacking domestic production.
We really are. And if you want concrete validation that this Prometheus joint venture is a serious operation, you just have to look at the Department of War's reaction. Shortly after Kratos broke ground on the Prometheus facility, the Dow directly invested $100 million of its own money into the energetics campus.
That is the ultimate stamp of approval. I mean, the government is essentially looking at the supply chain crisis, looking at Kratos and saying, we need this domestic energetics capacity so badly to counter China, we aren't even going to wait for you to finish building it with your own money.
Yep.
Here is $100 million in federal funds to speed up the construction.
And the revenue targets Kratos has set reflect that extreme urgency. Management is publicly projecting that the Hypersonics division will generate $400 million in revenue in 2026.
Okay.
And then it's going to step up massively to $700 million annually by 2027. That happens once the Prometheus facility comes fully online and starts churning out motors.
But wait, if Prometheus isn't fully certified and producing solid rocket motors at scale until 2027, how does Kratos hit that $400 million target in 2026? Are they just assuming they can magically pull revenue forward?
No, they are utilizing their existing external supply chain to bridge the gap. The sources note they are aggressively bringing in 120 solid rocket motors from external suppliers in late 2026.
I see.
They are using their working capital to stockpile these motors to fulfill immediate launch manifest over the next 12 months. That ensures there are no gaps in delivery to the DoD until the Indiana facility is self-sufficient.
Okay, so let's zoom out and look at the map we've drawn here. We have this incredible growth story. They are pre-building Valkyries with their own cash. They've secured a $446 million prime space contract by leveraging OpenSpace software. And they are building a 500-acre hypersonic testing and manufacturing campus in Indiana.
It's a massive footprint.
It all sounds fundamentally bullish. But between building massive factories and pre-building fleets of advanced drones, Kratos is spending an absolute fortune.
Yes, they are.
And this rapid, highly capital-intensive expansion has terrified some retail investors. We need to do a dilution forensic because that $1.35 billion cash pile didn't magically appear out of thin air.
They certainly didn't. The cost of this expansion was borne directly by the shareholders.
Let's talk about that cost. Because as an investor, this is the part that hurts. All this growth comes with severe shareholder dilution. I'm looking at the balance sheet, and the weighted average diluted shares outstanding jumped
It
massively.
was a big jump.
In Q1 2025, Kratos had 156.2 million shares outstanding. By Q1 2026, they are up to 179.4 million shares. That is a staggering amount of new stock issued in a single year. My slice of the pie just got roughly 15% smaller.
It did.
Why should the market be okay with management destroying that much equity value?
Well, you are right to look at that 15% dilution and wince. But you really have to contextualize that dilution against the alternative paths management could have taken.
What were the alternatives?
Management has a very strict, almost dogmatic corporate philosophy. They refuse to take on toxic debt. And they absolutely refuse to take on fixed-price development contracts from the DoD.
Let's explain that distinction. Why are fixed-price development contracts considered so dangerous?
Because in a fixed-price development contract, you are legally agreeing to engineer and build a technology that has literally never been built before, and you agree to do it for a strictly capped price.
Right.
So if the engineering turns out to be harder than expected or raw materials suddenly cost more, the government doesn't give you another dime. You, the contractor, have to eat 100% of the cost overruns.
Ouch.
Yeah. On the earnings call, CEO Eric DeMarco explicitly pointed to Boeing's historical missteps in this exact area.
Right, Boeing is the ultimate cautionary tale here. They took on fixed-price development contracts for the KC-46 airborne tanker and the new Air Force One jets.
And how did that work out for them?
Horribly. They ran into massive engineering delays, supply chain issues, and ended up losing billions of dollars, completely wrecking their defense margins.
Exactly. Kratos looks at that and refuses to play that game. Instead, they fund the research and development themselves, using equity. Because they self-fund, they retain the intellectual property rights to the drone or the software.
Which is incredibly valuable.
Very. Once the technology is proven, they only sell the finished product to the DoD on fixed-price production contracts. At that point, the manufacturing variables are known, and the profit margins are highly predictable and safe.
Okay, I follow the logic. The dilution from issuing those 23 million new shares was the conscious, strategic price paid to achieve that zero-debt fortress balance sheet.
It was a trade-off.
They sacrificed a portion of existing equity to ensure they never get caught in a debt trap or a catastrophic fixed-price development contract. And as we discussed earlier, that pristine balance sheet is what allowed them to win the prime contracts in the first place.
Exactly. It is the brutal, unavoidable cost of admission to leapfrog into the top tier of defense contractors.
I can accept the corporate dilution argument, but that brings up a massive glaring red flag regarding insider optics.
Ah, yes. The CEO's stock sale.
Right. If the future is so bright and this equity strategy is so sound, why did CEO Eric DeMarco set up a plan to sell 800,000 of his own shares? Several analyst reports highlighted this as intense insider selling.
Makes a great headline, I'll give them that.
How does that massive stock dump square with his public commitment on the earnings call to a 100 basis point annual EBITDA margin expansion? I mean, if he truly believes profitability is increasing, why is he cashing out?
This is a classic example of a scary headline completely obscuring the mundane reality of executive compensation. Let's deconstruct the insider selling narrative, because the SEC filings are very clear on this. The 800,000 share sale is absolutely not a panic dump.
Okay, what is it then?
The 10Q explicitly states that DeMarco adopted a Rule 10b5-1 trading plan.
Right. For the listener who hasn't spent time reading SEC regulatory filings, let's clearly define what a 10b5-1 plan actually is and why it matters in this context.
A 10b5-1 plan is a pre-scheduled automated trading contract that corporate executives use to sell their stock over a long period of time.
Over a long period, not all at once.
Right, because executives constantly possess non-public material information about their company. They can't just log into an app and sell stock whenever they want without risking insider trading charges.
Right, that makes sense.
So they set up a blind trust that automatically sells a set number of shares on specific calendar dates. It's completely independent of whatever good or bad news is happening at the company. DeMarco's specific plan runs all the way until June 2029.
So it's a slow drip over 3 years.
Yeah.
He isn't mashing the sell button because he knows a bad earnings report is coming. An algorithm is just trickling out shares for standard wealth diversification.
Precisely.
But still, 800,000 shares is a massive chunk of equity. Does he have any skin left in the game after this plan executes?
A massive amount of skin. If you look at the proxy statement data referenced in the financial disclosures, you get the real picture. Even after fully accounting for this 3-year automated trading plan, DeMarco still holds over 1.1 million shares directly or indirectly.
Oh, wow.
Furthermore, he holds 745,000 vested restricted stock units, RSUs, that are locked up until 2029.
Okay, so his personal portfolio is still heavily anchored to the stock price.
And here's the most important metric. He also holds an additional 750,000 unvested performance-based RSUs.
Unvested?
The key word is unvested. Those shares only become his property if Kratos successfully hits specific, highly aggressive performance metrics over the next few years.
Ah. So his personal wealth generation is almost entirely tethered to actually delivering on those margin expansion targets he promised Wall Street.
Exactly. When he promises a 100 basis point EBITDA margin expansion, meaning for every $100 million in revenue, they generate an extra $1 million in pure operating profit. It isn't just a hollow promise to analysts. It's the literal key to unlocking his own compensation.
Which gives him a massive incentive to perform.
Absolutely.
Yeah.
And that margin expansion is entirely credible when you factor in the transition to the high-margin OpenSpace software licensing and the massive cost savings from internally producing the Spartan jet engines we talked about earlier.
Yeah.
The 10b5-1 plan is just standard executive financial planning. It does not indicate a lack of confidence in the underlying business.
So, with the financials decoded, the philosophy unpacked, the physical scaling analyzed, and the risk laid bare on the table, it's time to synthesize all of this. We need to answer the ultimate question we posed at the very beginning of this deep dive. Disruptor or dilution trap?
Let's weigh the evidence.
We have two competing narratives. On one side, the bulls argue Kratos is an oversold growth machine that is hitting a massive production inflection point,
Right.
perfectly aligned with the Pentagon's desperate need for affordable mass.
Right.
On the other side, skeptics argue it's a capital intensity trap that burns through cash so fast it is destined to just keep issuing shares, diluting owners forever just to survive its own growth. Where does the data lead us?
The data leads us firmly into the disruptor category.
Yeah.
And the distinction really comes down to the quality of the cash burn.
The quality of the burn.
Yeah. A true capital intensity trap is a company that burns cash to build conceptual products that have no guaranteed market, with no path to recurring high-margin revenue. That is fundamentally not what Kratos is doing.
Right.
Kratos' negative operating cash flow is highly targeted. They are intentionally draining working capital to build tangible, company-owned assets like the Lot 12 Valkyries and the Indiana Hypersonic facility that have immediate proven demand from the DoD.
Right. The fact that they literally logged a $4.2 million cash inflow this quarter just from selling the pre-built Valkyries proves the demand is real. It's not speculative inventory sitting in a warehouse gathering dust hoping for a buyer. It's inventory simply waiting for the DoD's congressional appropriations ink to dry.
Exactly. And the second, vital part of the verdict relies on the software pivot. The highly capital-intensive hardware side of the business bending aluminum for drones and pouring energetics for rockets is now being actively counterweighted by the shift to prime status on software-driven programs like the $446.8 million GMI award.
So they balance each other out.
Exactly. By controlling the OpenSpace software network and the global SDA sensor array, they are securing the high-margin, sticky, recurring revenue that balances out the heavy industrial capital expenditures.
So to summarize the entire strategic roadmap for you listening, Kratos has successfully built an inimitable moat. They are the only defense contractor offering functional, affordable mass like the sub-$500,000 Firejet, specifically because they swallowed the supply chain and own the internal engine production.
Which is a huge structural advantage.
Simultaneously, they are controlling the high-margin software networks that dictate how those kinetic assets communicate in space. The 15% shareholder dilution from the $1.35 billion equity raise was undoubtedly painful in the short term, but the data suggests it was the necessary price of admission.
It was a necessary evil.
It allowed them to leapfrog into the top tier of defense contractors, securing a bulletproof balance sheet without taking on toxic debt.
They essentially traded equity for institutional credibility, prime contractor status, and massive manufacturing scale. And given the record $2 billion backlog and the $14 billion pipeline of upcoming contract bids, that trade appears to be generating massive long-term value.
Which leaves us with a final, slightly terrifying thought to ponder regarding the broader defense industry.
I know where you're going with this.
If Kratos is this successful, if they actually manage to normalize the 85% solution across the entire Department of War, what happens to the legacy prime model?
It represents a systemic, existential threat to the old way of doing business.
If the DoD officially stops funding these 15-year, trillion-dollar exquisite platform programs and instead pivots entirely to the cheap, rapid, tradable technology that Kratos is pioneering, do the legacy giants like Lockheed, Boeing, and Northrop Grumman adapt their massive, slow-moving bureaucracies to compete on price and speed?
Historically, no, they don't.
Or do they simply look at Kratos's $1.4 billion cash pile, their inimitable internal engine moat, and their prime software status, and decide they have to start acquiring disruptors like Kratos just to survive the new era of warfare?
It's the classic buy versus build dilemma on a massive scale.
It's a fundamental shift in the economics of global security, and it's something every investor and observer needs to watch very closely over the next few years.
The underlying economics of the defense industrial base are being rewritten in real time, and right now, Kratos is the one holding the pen.
Risk defined, portfolio protected.